With time, the new generation is becoming more financially aware and financially literate than before, and at the same time it is also becoming aware that living a monotonous life even after working hard till old age is not the right way to live. That's why today's generation is more focused on early retirement, passive income and financial freedom, hence people are showing more interest in investing in stocks and shares. But the problem that most people face is which stocks to pick, because buying quality stocks at the cheapest rate is the real challenge of investing. For which author David Soliomi in his book The Falcon Method teaches us an investment method that is based on the principles of value investing, common sense and basic discipline, whose ultimate goal is that you build a portfolio of such stocks so that you can generate your passive income along with returns. Friends, in fact, falcon is the name of a bird that specializes in hunting, and this method also works like a falcon bird. Because author David Soliomi, after seeing a lot of financial struggles at a young age, decided that he would not get caught in this rat race. That's why he read many books related to investment, and at the age of 24 he made and sold his first company. Even after that he made and sold companies in many different fields. Due to which he got a lot of inside knowledge of the company, which normal investors never get to know, which helped the author a lot in becoming a better investor, and then he became financially free at the age of 33, which if you also want to do and want to generate passive income for long-term in stock investing, then definitely watch this video till the end. Number 1. The black box. Author says that whenever you invest in a company, you should treat that company like a black box, where two types of pipes are attached. Some are input pipes, from where all the revenue scheme of the company is connected, from where the company gets money by selling its products or services, by taking a loan from the bank, or in the form of equity shares where the public buys the company's shares and gives them money. Other side, all the expenses of the company flow through the output pipe, cost of maintaining the company, salary of employees, production cost, marketing cost, etc. But author says that you have to focus on one output pipe, which is profit, because even after fully understanding the working of the company, you only care about your profit. Which you can understand from these three factors: that how a company is using its profits. Payment to shareholders. How strong is the company's return investment ratio, so that you can determine how much ROI you can get from this company. Share buyback. Share buyback means how much a company buys its own shares to limit its publicly available shares and how much profit or loss the company makes by doing so. Retained earnings. These are the earnings that the company saves in the capital fund of the company for its future expenses. Number 2. The quality criterion. In the Falcon Method, the author says that you should invest only in those companies which have been established in the market for a long time, and are industry leaders. You have to select some top companies from all sectors which are giving high returns consistently for last 20 years. Because mediocre company can give you high returns in short term, but if you want to generate passive income, then you should invest with long-term vision, which can generate your income continuously. Author says that after seeing the long-term history of the company, you get a very clear idea, because in a period of 20 years, at least one recession comes, and if the company is growing by beating that recession and maintaining its returns, then that company has the potential to generate passive income for you. Number 3. The value criterion. Everyone wants that they get all the high-quality things at the lowest price, but people do not do bargaining while buying stocks because they do not know what is the real value of that stock. Billionaire investor Warren Buffett says, whether stocks are up or the market is down, I always prefer to buy quality merchandise cheaply. By buying stocks cheaply, your returns get boosted in the long term. But to know what is the actual price of this stock, it is very important to know about the valuation of the company, to check which you can use indicators like price-to-earning ratios and price-to-cash flow. From which you can find out how much profit or loss that company is in, how the company has maintained its cash flow, and what is the value of the stock of that company, and how cheap or overpriced it is according to the market. Basically it means that when the market is down, you should buy the shares of your top selected company. Number 4. The threshold criterion. You want to get the maximum return for every dollar you invest. That's why it is very important for you to see how much the company earns per share, which is called FCF yield. Also, you should check that how many returns the shareholders get through dividends and buybacks, which is called shareholder yield. And also it is important to know the dividend yield of that company, that means how much dividend any stock can give you in the future according to its today's price. With these three criteria, you can find out whether the stock in which you are going to invest your money is really worth your money or not. The author says that using these three criteria, you should rank the selected company and see which company has the potential to give you maximum returns and invest in it. Number 5, Quantum Investing Model versus the Falcon Investing Model. Most people generally use the quantum investing model to invest their money in the market. In this model, an investor studies the company thoroughly, its business model, reputation, growth, profit, dividend. Keeping all these factors in mind, the list of companies comes out in which they would like to invest their money. And such people leave their money invested for at least 1 year, after which they get very good returns. When the profit comes in, they sell those shares and invest in another company or diversify their investments using the same model, and repeat the process every year. Author says that there is no harm in this method, because it is purely based on data. Your emotions do not affect your investing. But in this method, you focus purely on the returns, due to which people invest in such companies, about which they do not know anything, and due to which many times investors have to suffer huge losses. To avoid this mistake, author created the Falcon method, a foolproof, highly structured investment approach that has the potential to create passive income over the long term. In the Falcon method, the author recommends using the buy and hold technique. You have to build such a portfolio that you can hold for the long term. That means don't buy and sell quickly. In the Falcon method, you never invest in an unknown company, and do not sell shares every year to earn returns, but hold them for the long term and build your passive income through dividends and compounding. Number 6, use a buy and hold stock portfolio. To generate passive income from stocks, you have to be very patient. Until your money touches the 8th wonder of compounding, you have to hold your stocks. Because in the long term, your money starts getting compounded at a very high rate, where even if you withdraw a certain amount from your investment, the rest of your investment will continue to give you high returns due to compounding, and a passive income stream of yours will also be generated. That's why you shouldn't sell stocks fearing losses due to market sentiment. Since your chances of losing in the long term are almost impossible, you should always hold your stocks, and wait for compounding magic. Number 7, when to sell. The aim of the Falcon method is that you have to buy and hold stocks, but there are some rare cases where you need to sell your stocks. The author says you should sell your holdings in these 2 cases: when the stocks become highly overvalued, that is, the share price becomes very high according to the actual work of the company. This is a sign that a financial bubble is forming in the company, in which case you should sell your holdings. In the second case, when the company reduces its dividend, which ultimately negatively affects your investment, that violates our Falcon method. In this case we should sell our shares. Because when we selected this company, we made our decision after calculating many factors related to its dividend, which cannot be valid after dividend cut. Because all our calculations have gone wrong, in this case also you should sell your shares, and apply the Falcon method again. So this video ends here. If you like this video, give it a thumbs up, and share it with your friends. For more videos like this, hit the subscribe button, and remember to click on the notification bell. Thanks for watching.